Welcome back to Beyond the Benchmark. I'm Ryan Kasper. It was a shortened trading week, but we still received a meaningful batch of economic data that helped clarify where the economy stands as we move further into 2026. The headline number was fourth quarter U.S. GDP, which came in at 1.4%, notably below expectations and down sharply from the strong third quarter. That slowdown was largely driven by a decline in federal government spending tied to shutdown effects, which actually trimmed more than a full percentage point from growth. Underneath the surface, however, the story was more constructive. Consumer spending remained solid, rising over 2% and continuing to anchor the expansion, while private investment, particularly in equipment and intellectual property such as data centers, also contributed positively. Early estimates for the first quarter are already pointing to a rebound, suggesting the softer GDP print may be more of a temporary distortion than a fundamental shift. On the consumer front, personal income and spending both surprised modestly to the upside. Income rose 0.3%, spending rose 0.4%, and services continue to carry the bulk of activity. Inflation, measured by the PCE index, ticked higher on both a headline and core basis and remains about a full percentage point above the Federal Reserve's 2% target. So, while growth is moderating, inflation hasn't fully cooled, keeping policy discussions nuanced. Industrial production was another bright spot, rising 0.7% in January, with strength in autos and high-tech equipment tied to ongoing AI-related capital spending. Manufacturing remains supported by investment in semiconductors and computing infrastructure, even as other areas like mining remain softer. Housing data was mixed and continues to reflect a market that is stabilizing but far from strong. Housing starts and permits saw some improvement, but builder sentiment remains deeply negative, and affordability challenges persist. While certain regions, particularly in the north, have rebounded, housing overall remains weak by historical standards. Labor data showed little deterioration, with jobless claims falling again and no clear signs of broad layoffs. Meanwhile, consumer sentiment held steady overall, with inflation expectations easing slightly, a small but welcome development. Markets responded positively. Equities gained globally, with international markets once again outperforming U.S. stocks. The rotation toward diversification outside of large-cap U.S. growth continues to be a theme. Bonds were largely unchanged domestically, while foreign bonds were mixed as the U.S. dollar strengthened modestly. Commodities continued their rally, especially energy, as tensions between the U.S. and Iran intensified, pushing crude oil higher. So the takeaway this week is balance. Growth has slowed, but remains intact beneath the surface. Inflation is still sticky. Housing remains a headwind. And markets are increasingly looking beyond U.S. large caps for opportunity. As always, diversification and discipline remain key as cross-currents continue to define this environment. I'm Ryan Kasper. Thanks for tuning in to Beyond the Benchmark. We'll see you next week.